Hi everyone, this is Kathy and Thomas on What's Up for mid-February 2024. So there's lots on the go, but today we're going to focus in on markets in particular. How did we do in 2023? I got my statement. I was happy. Yay. Where we are now, and Thomas, I'd like you to look at your crystal ball and tell us about the year coming, set some expectations. We're then going to move on to a market opportunity that we see coming, maybe not as quickly as we originally thought, but we see some opportunity in the market. So we want to make sure that you're aware and that we're aware and we're moving on it. So we've got lots on our mind as usual. So without further ado, Thomas, tell me about last year and the great numbers I saw in my statement. Yay.
Yeah, it was a great year, Kathy, and I think one that not a lot of people expected. I think we look into a year with rising interest rates. Not a lot of people expected the double-digit returns across the board in various different global equity markets. So it was a surprise to some, not the best expectations coming into the year, but overall, our clients and we're very happy with how the year ended up.
So what were the high points of last year? Where did I see a great performance? What categories?
Yeah, if you were in the seven names, the now coined Magnificent Seven, which are big tech names in the States, which now make up almost 30% of the entire index of the States. Very well diversified in the biggest economy in the world, and has been surprisingly very concentrated to seven names, and those names I'm sure everyone knows at this point, but the Apples, the Microsofts, Nvidia, Tesla, Google, those names have dominated. And if you were in those seven names, which we were, we had some good exposure towards that.
We did.
You were a winner in 2023, and if you weren't, sadly, you kind of got left behind. It was a tale of two halves as far as returns went this year. And if you didn't have exposure to these seven names, unfortunately, it wasn't really much else out there. The rest of the index really got held back, and it was really these seven names that pulled up the index.
So that to me sounds like primarily the NASDAQ, which the year prior, 2022, due to war situations, we took a bit of a hit throughout all the markets, but the NASDAQ sure bounced back.
We did.
Holy cow, yeah, it was great. We also had an interesting play on Canadian banks. We always like Canadian banks. So they were trading at kind of low price earnings. Tell me about the banks, and by September we were starting to buy some. Your recommendation looked like opportunity.
Yes, and as you know, when opportunity arises, Kathy hits the phones, and in our client meetings we were preaching on the banks. The Canadian banks, we like them as we see them as more or less an extension of the government. They're well protected, well capitalized, and we have tight regulations here in Canada. So when the banks come on sale, which doesn't happen that often, we jumped on the opportunity to buy them. And what happened with the banks was they were beat up due to the banks setting aside money for what's called credit for loan loss provisions, meaning that the bank always they predict and they protect for the worst case scenario. And then what that happens is they write off assets preparing for mortgage defaults. And if that doesn't happen, what we're hoping for is a year like 2020, when the money then comes back on the balance sheet and it comes back on as a pure asset, which would be incredible for the banks. And we could see a year like we did in 2021 with the banks. When what happens is with the banks, when the price drops, the Canadian banks are in a group called the Dividend Aristocrats, which means these banks have 50-year track records of not cutting their dividends. So when the price sells off, the dividend stays the same, meaning we can buy banks for a higher dividend yield, and we're buying them when they were yielding 6-7%.
Love those Canadian banks, love that div yield. In a non-registered portfolio, of course, they're tax preferred. And when the markets jitter, that dividend yield kind of covers our backs. So here we are now. We've had a pretty good start, and what are we, 2024 now?
2024.
Wow, it goes fast. We're still working on taxes for 2023, so we're spanning somewhat 2 years. So we had a pretty good start. Fast off the mark.
Yep.
So what's performing now, and what are we hopeful on And then I want to get to opportunity.
Yeah, at the time of recording this, we're only a couple points away from 5,000 on the S&P benchmark, which is quite significant. We were at 4,000 3 years ago, so being up at 5,000 now, a 20% gain is quite something. It's been a good rebound in stocks, and it wasn't too long ago, back in 08, we were trading at 1,500 on the S&P. So to be at 500 now, 16 years later, is quite the mark. But this year too has taken off where last year led off, and that is the big seven names, and have continued to carry on, minus a couple of leggers in the group. But Tesla has since pulled back, but the rest of the names, the big ones, the Google, Amazon, Microsoft, Nvidia, all had incredible Q4 earnings beats, and they're the ones too that are continuing this the momentum here in the market.
So because they've performed so well, we're going to be a little bit more cautious that you're not exceeding your risk tolerance. So we've got a little bit of beware, be cautious. We're very cognizant of that when something's particularly high. We kind of morph to what's not doing so well. We're contrarians.
We are.
Tell me about this opportunity that I never suggest.
Yes.
And it involves
bonds.
Bonds.
Something that
it's rare that I recommend bonds.
We haven't talked about it for a while, but now it's we're in an era right now, in a time in the market where people are coining it to be kind of a Goldilocks environment for bonds. So right now, we always like to say that there's always an opportunity out there somewhere, and right now it can be easy for people to want to pile in into this rally. People see these names coming up, and we're in what's called the euphoria stage of this market, and you definitely don't want to be the last one buying in. We want to buy low and allocate new funds to pull back, to trim high and reinvest in at lower levels. And we're seeing that right now with bonds, with fixed income. And two key factors that we like about bonds is, one, we're locking into good yields. Just due to interest rates right now, we have some bond funds that are yielding us 5-6%, which is great. And the biggest indicator and the biggest tailwind for bond performance is when rates get cut, which we're expecting this year. Expectations have come down a little bit. We're expecting some rate cuts earlier on in the year. That's just been pushed out, which we think is healthy for the economy here. A little higher for a little longer. I know people, home buyers, along with investors, are waiting for those first cuts. It's bullish for equities, and it's great for bonds as well. So we're looking to maybe take some of that risk from the Nasdaq, the technology, go into something a little more cooler, into fixed income. We think it's a great opportunity to get some lower risk returns at some great bargains right now.
So bonds are really favorable when interest rates are dropping. They were not favorable when interest rates go up, because the new bonds are going to yield more. So in this case, the bonds that we're buying today, that yield is set. So you get two avenues of appreciation, the yield and the capital gain on those bonds. So we've been having a heyday in money market.
We have, yes we have. Yeah.
So money markets, tons of money is in money markets right across the board, and certainly with us. So money market has been yielding about 5.5. No fees, because it's a cash asset, like cash, GICs, we don't charge fees on this. But with interest rates dropping, those money market funds are going to diminish. The yield's going to diminish. So we're going to take a look at what you have in money market and start to suggest some switching on over to bonds where we see that appreciation coming. Now, if the money's for short term, definitely we stay in money market. But if we have a bit of time on it, it's always nice to make more money.
Yeah, sure.
So we see this as quite an opportunity. A couple more things roaming around. It's a very complicated, interconnected situation. We have geopolitical issues, but also we have inflation. And I'd like to address why we have inflation and some of the oddities of it. Number one, our immigration policies. So last year we brought in 1.3 million immigrants from places all over the world, and we welcomed them. They needed to get out of danger. The year before it was 1 million. So Canada has onboarded 2.3 million people in 2 years. We are growing. Our Canadian population is growing more than an emerging market. Canada, emerging markets. We are not the northern tiger, we're the northern pussycat. This is really extraordinary. Now, this is blowing up a bunch of our systems, a bunch of our infrastructure, in particular, our hospitals, our education system, and our housing market, which is part of an element of inflation, housing being buying and renting. So when you have this massive people arriving, you're going to get some inflation because of the sheer numbers. So when they take a look, when the Government of Canada, the Bank of Canada looks at the inflation numbers, the culprit kind of is immigration. So the most that Canada can absorb in a year is 300 to 500 new people. So I hope the government is reading their numbers and their figures, because with all these factors, the Bank of Canada is saying we're going to delay some of those interest rate cuts. So it seems to be we're not going to raise interest rates. We are going to bring them down, but it might be a little slower, but anticipated is 3 to 4 decreases for those renewing debt. So there's a lot of factors going into this, isn't it, Thomas?
They are. It's a very complex time that we're at right now, but I think we think more now than ever, all the more importance for advice and sound advice and sticking to our investment philosophy and what we do and not getting carried away, reaching for returns, but instead staying within our competency, what we know, and sticking to our disciplined investment approach.
Right on. So we appreciate the trust you have put into, the trust that you've given us. Our intergenerational team works hard, we're very thoughtful, and we really appreciate you. So thanks so much. Bye for now.
Bye.